Have you ever wondered how the worlds of real estate and Bitcoin could merge to create a groundbreaking investment strategy? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Cardone Capital has recently made headlines with the launch of a $235 million hybrid fund that ingeniously combines multifamily real estate with Bitcoin investments. This innovative approach could potentially reshape how we view and engage with real estate investments. According to VentureBurn, the fund includes a $100 million allocation to Bitcoin, paired with a significant multifamily property acquisition. The strategy is straightforward yet revolutionary. Rental income from the property is funneled into continuous Bitcoin purchases. This creates a blend of stable real estate assets with the potential high returns of a volatile digital currency. Grant Cardone, the mastermind behind this model, describes it as a form of dollar-cost averaging, where the property's operational performance drives long-term digital asset accumulation. This means that as the property generates income, it simultaneously builds a Bitcoin reserve, creating a treasury backed by real tenants and real income. The fund represents one of the most direct attempts to merge commercial real estate with long-term Bitcoin accumulation. Cardone believes that this innovative mix provides stability and exposure to digital assets through a business model with genuine revenue streams. The potential for this fund to become a public vehicle, trading like a stock backed by both real estate and Bitcoin, showcases its groundbreaking nature. Interestingly, this hybrid approach could offer a solution to the vulnerabilities faced by traditional crypto treasury firms. Unlike firms that rely on market performance and speculative fundraising, this model leverages the dependable demand for housing. This creates rental income that supports Bitcoin accumulation without the reliance on debt, even during market downturns. The Boca Raton multifamily property anchors this new fund, offering predictable occupancy and stable operating margins. This foundation is expected to sustain regular Bitcoin purchases for many years, potentially inspiring other firms to consider similar strategies. Cardone envisions hybrid funds playing a significant role in future real estate markets, with investors soon demanding exposure to both physical and digital assets in the same vehicle. H&R Real Estate Investment Trust has announced plans to sell approximately $2.6 billion in assets after concluding a strategic review without securing a takeover offer that met management's expectations. The REIT, which owns and operates a diverse portfolio of commercial and multifamily assets valued at approximately $9.6 billion, is expected to see its portfolio size decrease significantly by the end of 2025. This move comes as part of H&R's efforts to maximize value for its shareholders, despite reporting a net loss of $322 million in the third quarter of 2025 due to substantial asset write-downs. The strategic review, initiated earlier this year, involved engaging with multiple parties interested in acquiring all assets of the REIT. However, the proposals received did not align with the board's valuation expectations. Consequently, H&R has opted to proceed with the divestiture of select assets, which are under binding agreements of sale. The properties being sold include retail and office spaces, with the largest holdings located in Toronto and Edmonton, as well as a significant office property in Houston, Texas. H&R's decision to sell these assets is partly influenced by fair value adjustments made during the third quarter. These adjustments, totaling $753 million for the year, included reductions in the value of office, retail, and land properties under development. Despite these challenges, the REIT completed several leasing activities during the quarter, securing new tenants for industrial properties in Toronto and renewing leases at office properties in Markham, Ontario, and Sydney, Nova Scotia. This leasing activity demonstrates the ongoing demand for commercial space, which is a positive indicator for the market. The REIT's financial metrics at the end of the third quarter show a cash and cash equivalents balance of $57.1 million, along with $345.6 million available under unused lines of credit. With an unencumbered property pool of approximately $4.1 billion, H&R remains in a strong position to continue its operations and pursue strategic opportunities. The REIT has maintained its dividend, with a payout of $0.05 per unit for November. reflecting an annual dividend of $0.60 per unit. While the reduction in asset values and the resulting net loss are significant, H&R's proactive approach to asset sales and leasing activities suggests a strategic repositioning that could stabilize and potentially enhance its portfolio in the long term. This approach aligns with the broader trend of real estate investment trusts, optimizing their asset bases to better navigate market fluctuations and capitalize on emerging opportunities. Alberta is on the brink of an economic surge thanks to multi-billion-dollar investments set to flood into the province. According to Scott Hutchison, executive chair of Aspen Properties, Alberta could see between $10 to $20 billion in new investments within the next year. Hutchison, who also chairs Invest Alberta, predicts that the first quarter of next year will be the best for investment in Alberta's recent history. In an exclusive interview with RENX, Hutchison went a step further, forecasting that Alberta could announce $50 to $60 billion worth of data centers next year alone. He attributes this potential boom to several factors, including Alberta's business-friendly environment, affordable land, an inexpensive power grid, and a naturally cold climate that aids in cooling data centers efficiently. Hutchison pointed out that Canada isn't fully developed in the data center sector, unlike the United States, which gives Alberta a competitive edge. The absence of tariffs on data also plays a significant role. Invest Alberta has engaged with developers, land speculators, and end users through letters of intent, highlighting the sector's rapid growth as an alternative real estate investment category. Data centers are seen as a high-growth area that could drive up the value of underutilized land, particularly in regions where industrial land prices are lower. This makes Alberta a prime location for these investments, as the province offers ample land that is less expensive than industrial areas. Kevin Leon, president of Crestpoint Real Estate Investments, echoed Hutchison's optimism during a roundtable discussion at the Calgary Real Estate Forum. Leon emphasized Alberta's favorable business environment, minimal bureaucratic hurdles, and potential political improvements. He also indicated his company's interest in multifamily projects and the office market in Alberta, citing long-term investment potential. Alberta's appeal is further enhanced by its population growth, making it an attractive destination for long-term investment. Leon is bullish on Alberta, acknowledging its challenges but expressing confidence that it will outperform the rest of Canada over the long haul. The influx of investment in data centers and the broader commercial real estate market positions Alberta as a key player in Canada's economic landscape. The province's proactive approach to attracting investment and fostering a conducive business environment bodes well for its future growth. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.